Principles of Accounting, Chapter 11. So in chapters 8, 9, and 10, we looked at budgeting and then variance analysis. In chapter 11, we're going to look at other ways besides the budget variance analysis that departments or companies use to analyze performance and look at ways that different divisions have performed. So we're going to talk about decentralization and responsibility accounting. So why is decentralization a good thing? And then on the next slide, why is it a bad thing? So why it's a good thing is that it frees up top management to think about strategy instead of everyday operations. Managers usually make better decisions because they're right there kind of in the trenches. They have more information. They don't have as many communication channels to get through as top level management. They're there on the ground. Also, having decision making authority makes them more satisfied with their jobs, more inclined to make good decisions by having that authority and being positively or negatively affected by it. And they can respond quickly to customers. So a manager in a division or in a store can respond to customers quicker than the CEO can of an organization. What are the disadvantages? A lot of it is caused by lack of coordination or lack of communication. So as a lower level manager, I might be more inclined to do things that benefit my own division, even if that means that they don't benefit the organization as a whole. Or I might make, and that can be for good or bad decisions. So I might make decisions that are bad for the organization as a whole, or I might make decisions that are good for the organization as a whole. But my main strategy is just in my own individual division or my own individual performance. So I might not see the entire big picture of the organization. I might also have a higher incentive to carry out my own goals instead of the goals of the organization. So those are usually some of the disadvantages to centralization, usually caused by poor communication between different channels. So responsibility accounting. This is where we talk about managers are held responsible only for those items that they can control. So we talked about responsibility accounting a little bit from previous chapter when we talked about the contribution margin and then controllable fixed cost and non-controllable fixed cost, and how non-controllable fixed costs shouldn't be used as part of performance evaluation for managers. So that falls under the responsibility accounting of we should only be judged by those things which we have decision-making authority over and not things that we don't have any control over. So different responsibility centers are cost centers, profit centers, and investment centers. So a cost center only has costs. They don't generate revenue. They need to control their costs or manage their costs. Usually a cost center is a center that provides some kind of service to the organization, but doesn't sell those services outside for a fee. So there's no revenue generation. Examples of this would be information technology or IT department, a human resources department, your accounting department. All of them provide a service for the organization, but the human resource department in your organization is not selling those services outside for a revenue. They're only performing at cost. A profit center has both costs and revenues. So the manager of those centers has control over the costs and revenues for that center. An example of a profit center would be an individual location of a chain. So we think about in Waverly, we have 2 Casey's or 3 Quick Starts. Each one of those locations has its own manager, and the manager is in control of the costs and revenues of that location. But they have no control over investment funds, and that generally comes down to like capital investment decisions. So They control the costs and the revenues within their own Casey's location or Quickstar location, but they don't get to decide where a new building is going to be built or if their building is renovated. They don't have that kind of decision. That comes from a corporate decision maker. And an investment center is a center that does have that capital investment decision making ability. So I can decide if I'm going to go into investments, I can decide if I'm going to remodel my building or not, in addition to having control and authority over my costs and revenues. So we evaluate these responsibility centers in a variety of ways. One of those ways would be in variance analysis, like we did in the past two chapters. Another way is looking at their return on investment, or their ROI formula. Return on investment is net operating income, so income before interest and taxes, also called EBIT, which is earnings before interest and taxes, divided by our average operating assets. So our productive assets, plant, equipment, accounts receivable, inventory, cash. Basically, how well are we making money with the investments that we have made into the organization? When we're looking at that average accounts or assets, we are going to use the net book value of depreciable assets and not the gross or acquisition cost. So instead of using the historic cost, we would use the book value, which is the value after depreciation. We can also break down the return on investment into the profit margin and the asset turnover ratio, as we see here. So the return on investment is either net operating income divided by average operating assets, or it's profit margin times asset turnover. So the lowest formula, that ROI equals margin times turnover, that is also called the DuPont model of calculating ROI. So for the profit margin, we have net operating income divided by sales. We've seen the profit margin calculation in other chapters before. And then asset turnover ratio is sales divided by average operating assets. So we're going to look at an example. So we have a company, we have information about their operating income, their average operating assets, their sales, and their operating expenses. And we want to know, what is this company's ROI, or return on investment? So we would take the operating income divided by sales times sales divided by average operating assets. So we get a profit margin of 6% and an asset ratio, or an asset turnover ratio, of 2.5. So what that 2.5 means is for every dollar we've invested in assets, we are able to generate $2.50 in sales. That's what that ratio tells us. So we take the profit margin times the asset turnover ratio, and we get a return on investment of 15%. If we make new investments, that has changes to our return on investment. So if we invest $30,000 in a piece of new equipment, that equipment increases sales by 35% and increases operating expenses by 15%. So our net change in operating income is $20,000, 35,000 minus 15,000. So we see the information here now. Now we have an operating income of 50,000 and average operating assets of 230,000. So now we calculate a new return on investment. We see that our return on investment has increased from 15% to 21.8% by taking on this new investment. Well, this is a great thing for us. We always want to find ways to increase our return on investment. So we would say that the investment in that piece of equipment is a good thing. It has a positive benefit. However, there are criticisms to the return on investment calculation. One we know we've talked about in many, many chapters is that if we use a single kind of measurement to judge performance, we might not make good decisions in an effort to control that measurement. So, one, if we're evaluated on our ability to maintain or increase our return on investment, we might reject investment opportunities that are actually good for the company because they lower our return on investment. We also, in the absence of a balanced scorecard, we may not know how to increase our return on investment or various ways. A balanced scorecard is a performance measurement system that looks at 4 different components of the business. Only one of those is financial. The other ones are different performance metrics based on non-financial measures. And managers that are new to the organization may have a lot of costs that they don't have any control over. So we talked about when we look back at previous chapters where we try not to evaluate managers on their non-controllable fixed costs. So another measurement that we can use in conjunction with return on investment is called residual income. So residual income looks at, let me cutting this slide off, looks at what is left of our income after the average operating assets times a minimum required rate of return. That minimum required rate of return is also sometimes called a hurdle rate in organizations. So this measures our operating income less the minimum required return on average operating assets. The residual income measurement encourages us to make good investment decisions that would normally be rejected under return on investment measures. So let's look at an example where we use that residual income. So we have a retail division of a company with average operating assets of 100,000, and we're required to earn a return of 20% on these assets. We have income of 30,000. So if we take our operating assets times that required rate of return of 20%, we get $20,000. We take that $20,000 away from our actual income, we get residual income of 10,000. If we would look at an investment, as long as that investment keeps us in positive residual income, regardless of what it does to our ROI, we would accept that investment then based on residual income measures.